Today on InvestTalk, we look at who will benefit from the boom in data center investments. Then we unpack the Fed's rate cut today. We also answer questions about CBS, PNC, Powell Industries, and more. And at the end, I look at why consumers are tapping their credit cards.
This is InvestTalk, independent thinking, shared success.
Now, our main focus point today is about data centers and how it's become a billion-dollar real estate investment boom. And there are over 2,800 facilities in the United States alone that are data centers. And this pales in comparison to next on the list in the world, which is the UK, less than 400 data centers there. And we all know these facilities have supported cloud computing for decades now, right? Cloud computing is a couple decades old. But AI is the new entrant, and it's certainly not slowing down. At least we know there's going to continue to be growth. Now, will it be at the same pace? I think that's a bigger question. But in general, these data centers are becoming more and more valuable. In fact, the land on where these data centers can be built are a lot of times the values of the land are doubling, tripling. Some of them, one in Virginia, for example, went up 10 times the original price. And it's all because of the access to cheap, reliable base load power. And that's why a lot of these are being set up in the Midwest, the Southeast, where there are a lot of nuclear plants, plants that run on natural gas, which is very cheap, et cetera. And so demand remains very, very strong for the right location and ways to support cloud and AI infrastructure. And within the REIT space and REIT investments in general, real estate investments, data centers are certainly the most exciting asset class as a whole. And you might say, okay, now I'm going to go buy a data center REIT. And that could be a path forward. But I've always been a bigger fan of picks and shovels. Picks and shovels. Because those are the companies that are going to be directly impacted. And what I mean by that is the companies that are helping facilitate the build-outs. Whether that is, you see that with NVIDIA, right? They're benefiting. But what about other types of companies? Companies that make wire, for example, that connect the computers. Companies that mine for copper, for example, that go into the wire and go into the computers. What about the companies that are supplying the electricity or maintenance on the facilities that supply the electricity? These are direct beneficiaries. And you see with the Inflation Reduction Act, there's a lot of incentives to build out these type of facilities and the infrastructure for these facilities as well. And so while the value of these properties continues to soar because of their relative location to the power grid, it's a lot more difficult to access that those type of real estate opportunities. But there are only select few type of companies that can actually help with the building of these and the billions of dollars that is directed towards the building of these facilities are going to a lot of those picks and shovel type of companies. And so I wanted to highlight this topic because of that. Because oftentimes when there are trends within the marketplace, it's not the most obvious companies that will benefit the most. And a lot of times the ones that are the most obvious maybe aren't the most durable either. So it's not just about the initial build out, but what about the continued growth year after year? And so this is a multi-billion-dollar industry that will continue to grow with AI, with cloud computing, and finding those picks and shovels will be the best path forward on the investment front.
Here's a quick reminder. The newest InvestTalk Wealth webinar is happening soon, Tuesday, October 8th at 11 a.m. Pacific Time. The InvestTalk Wealth webinar will focus on effective strategies for managing your 401k and enhancing your retirement savings. Go to investtalk.com and sign up for our upcoming Wealth webinar, October 8th. It's free to attend, but you must pre-register. And please tell your friends.
Now let's take a quick look at the market today. It was Fed Day, and I'll talk a bit about what they said, but ultimately it's what the market did, right? Which was frankly reverse. And this is a good example of buy the rumor, sell the news type of event. This was the most signaled rate cut in general, right? It wasn't signaled whether it's going to be 25 or 50, but it was 100% clear they were going to cut rates this meeting. And, you know, it's something I still see the average investor have struggled with, which is, oh, when the Fed cuts rates, that's going to have an impact on markets, or that's going to impact the mortgage rate, for example. When the reality is that's all priced in. It's known, okay? And what you saw were rates actually rise a bit today. The 10-year closed yesterday at about 3.63%, and we closed today at 3.68%. So about 5 basis points rise on the day. Nothing huge, but you would think, oh, the Fed cut rates. Rates are going to drop today. No, rates were up today, actually, because the path forward in rates were, at least the prognostication from the Fed, was a bit more hawkish over the medium term than markets had priced in. And so rates rose a little bit. And so that's a lesson here, that it's when you're trading markets and you're buying something, it's not about what is known, okay? It's about what is priced in versus what the reality is, okay? Just like earnings, right? Earnings come out, if the market was pricing in much better growth, right? 30% growth in earnings, they came in at 25, and then the market expected them to guide to, 35% growth in earnings, and that guidance only came in at 30%. That 25 for the last quarter and 30 for the next quarter sound great, but it was less than the market had been expecting, and so the stock will likely decline on that. Okay, and so that is a big lesson here today. Okay, the broad market was generally down, and nothing really to worry about. Right, but large cap growth was down 0.75%. Okay, if you look at like the most active names, Nvidia was down 3% or 2%. Intel was down a little over 3%. What else? Open Door was down 7%. Neo was down 7%. What are some other big movers? Trump Media, that was down 13%. What else? The big movers up, not a lot of big movers up here, but that was really the reaction to markets was, yeah, great, you cut rates by 50 basis points, but the path forward was a little bit more hawkish, and therefore you saw rates rise, you saw the dollar actually rally and close near the highs of the day, and I could easily see this be the start of a modest pullback in markets. I've said this between now and election day. I do expect markets to be choppy and have volatility a little bit higher than normal. And a lot of this is seasonal, right? We know that September tends to be fairly negative. The back half of September is actually the worst part of September. So we're in that back half. And so would not shock me to see a bit more volatility in the short term now that we're past the Fed meeting. And the market's trying to figure out, what does this mean for the economy as a whole, and what does that rate path mean for asset prices in general? So that's kind of where we're at. Gold prices dipped as well. So I do think that was a little bit overbought. You could see a bit of a pullback here. Probably still a pullback to buy, but that was the Fed meeting there, at least the market reaction to the Fed meeting. And then now it's really eyes back on the economy. What is inflation going to continue to ebb throughout the month of September? Where do oil prices go? Obviously, geopolitical concerns continue to arise. You have the recent Hezbollah news with blowing up of radios and pagers and things like that. And what does that mean for geopolitical tensions in the Middle East? Obviously, the election, and that will probably play into what happens in Ukraine and Russia, and with trade negotiations worldwide as well. So all of what we're seeing over the short term, really, right, next 6 weeks, 7 weeks, will certainly impact markets. And don't be surprised to see volatility trend a bit higher in the near term.
Good afternoon. This is Jeffrey from Alabama, and I'm a longtime listener. Enjoy the program. Got a question for you on Franklin International Core Dividend Tilt Index ETF, symbol DIVI. I was going to get your analysis and opinion on this for a 3% position, giving international exposure. Appreciate it. Be listening on the podcast.
All right, looking at DIVI, which is the Franklin International Core Dividend Tilt Index. So it is an index, but with a dividend tilt. And when you are tilting towards dividends, you are naturally tilting on the value side of the market. And that's what this is. This is a large cap value fund. The top holding is Novo Nordisk, then ASML, Novartis, Nestle, HSBC, AstraZeneca, Roche, SAP, Toyota, and Allianz. Those are the top 10 holdings in this name, but there are also 464 in total. So it is well diversified. And from a sector perspective, good amount of healthcare, a lot of financial services, which you would imagine with international stocks, there's those international banks, but there aren't a ton of, large mega cap companies. And so you tend to tilt towards the financial services, which once again, tend to be more on the value side, pay dividends, etc. Now, let's take a look at the cost here. 11 basis points, 0.11% is the expense ratio. That is fairly low. So I like it, not necessarily because of the dividends, but mainly because the dividend tilt, as the title says, basically tilts it towards the value side of the market. And it's fairly low expense ratio. So, if you want to index, this is not a bad way to go about it. That is DIVI. International exposure right now with the dollar weakening is not necessarily the worst thing in the world. Okay. Now, I hope you're telling your friends about the InvestTalk audio podcast being available in video form now over on YouTube. And we get questions submitted via the comment section over there. So you can go over there and ask your question as well. But Ish1412 says, quick question regarding rescheduling of cannabis and IIPR in innovative industrial properties. Do you think if cannabis is rescheduled to Schedule 3, it will hurt this business? I believe the operators have no access to capital that helped IIPR in the past. It is my understanding that the operations would be able to get loans and would not be as dependent on the sale leaseback for funding. I understand the rescheduling would remove 280E tax burden and would help their tenants. I would love to hear your thoughts on how rescheduling would affect IIPR. We actually think it would be net beneficial. There'd be more options for the cannabis growers, producers, those facilities, but it's not all of the value that IIPR brings. We actually own it for clients, and we think that there's local laws that need to get approved for that IIPR can help with, right? Because they know the lay of the land, et cetera. And they can still offer, just because they have more access to capital doesn't mean that it's going to be cheaper capital either, okay? And what it's also going to mean is that in a tough situation, those that do have leases with IIPR, they will be able to get more financing, so less defaults as well. So I think there's some upside there as well. The tenants will actually be a bit better. So we actually think rescheduling of cannabis to Schedule 3 would be a modest net positive for IIPR. And I think that's one of the reasons why it's at a 52-week high.
This is James from New York. I'm looking at PNC Financial, ticker symbol PNC, and wondering what you guys think of it. We'll be listening to your answer on the podcast. Thank you so much. Have a great night.
All right, looking at PNC Financial, $72 billion market cap. And it's a holding company for PNC Bank, operating 600 branches in Pennsylvania, New Jersey, Delaware, Washington, D.C., and some other states. So fairly well diversified in kind of the Midwest and the East. And, you know, it's kind of a mixed bag when it comes to the demographic shifts there. Now, one thing I will say, though, is this is more of a mid to large bank. It's not a small bank. It's not one of your normal regional banks that has a $5 to $10 billion market cap. It has $72 billion. PNC is not a small bank anymore. And I think their heft will allow them to have a fairly good profitability. And more assets will tend to migrate that way. Okay. And that is one thing I do like about PNC. Now, it's a riskier bank than like a JP Morgan, but, you know, the trends are certainly positive. If I bring up the chart here, it is near a 52-week high, marching higher. So, you know, I don't love banks in general right now, just as where we are in the cycle, increased regulation. But if I'm going to buy a bank, it's going to be one of the larger ones, and this is, in that ballpark. So I'm fine with it. If you are going with a bank to add to your portfolio.
Hello, InvestTalk. This is Matt calling from Tel Aviv. I have a question about AAON, ticker symbol AAON. I bought a small position in the high 70s and it went up to the high 90s. I would like to add to this position as a play on the growing demand for HVAC systems. What are your thoughts in general about the company as a long-term hold? I would love to get a price point that you find attractive to buy some more. Thank you and love the show.
All right, looking at AAON, AAON is the symbol, and that's how you spell the name of the company as well. And like most of the HVAC companies out there, it's a good business. It's a very good business. The return on equity is about 26%. Its 5-year average is 21.5%. And it's been between about 12% and 28%, 29% return on equity for the last couple of decades. So, you know, it goes up and down, but generally it's a very profitable business. They have pretty much no debt, which, as you know, we love. The problem is that it's pretty expensive. Enterprise value to EBIT around 26 times, which is on the high end of its, 10-year range. At the low end would be closer to the mid-teens. It's at 26. And so, I'm willing to pay a premium, but am I willing to pay 26 times? Not really. Its free cash flow was $102 million trailing 12 months, which is good, but not compared to its market cap of nearly $8 billion. You're talking about a 1.5% free cash flow yield. That is not exciting. And they're buying back shares, but their announcement was $25 million worth of shares. That's next to nothing. That's a third of 1% of the shares outstanding. It's not a lot. Okay. So, I just think it's too expensive. I think it's a good business. I would want to own it. If I'm going to buy more, I want to be buying it at a much more reasonable price, which it's not trading at right now. Now, where would I pick it up? $58? $60, somewhere in that range, 60 to 65. That's an area that would get me jazzed up and excited. But you're near a 52-week high. And so I just don't see any hurry to pick it up at these levels. So good long-term hold, but I'd be waiting for a better buying opportunity. Now let's play two in a row from 888-99 chart.
I'm calling about CUBI, CUBI. And I was just wondering what you think about that in this sort of environment of inflation and stuff like that. Anyways, love the show. Keep doing what you do and have a good one.
All right, looking at CUBI, and this is Customer Bancorp. And this is a good juxtaposition to the previous caller about PNC that has $75 billion market cap. CUBI has $1.5 billion market cap. Okay. So much, much smaller. This is that your standard regional bank. They only have 16 bank offices. Okay. And these are the type of banks that I don't want to own. Just too small, not a lot of scale. And I think these are names that will continue to struggle. And in fact, the near-term chart is fairly bearish. It moved down in August from $68 per share to a low around 45, and it's been chopping sideways and it sits about 48 and change at the close today. So the technicals are, I would say, neutral to slightly bearish, and it's a small bank. Its relative strength is only, let's see if my cursor wants to work for me. There we go. Its relative strength is only 63 versus PNC, it was 88. Okay. So it's not doing terribly, but compared to other banks, especially larger banks, it's not doing very well. So I'm passing 100% on CUBI. I think there's much, much better options out there if you're looking in the banking sector. And we just talked about one earlier in the show. Now here's another question from our InvestTalk YouTube channel. John 14235 says, thank you for the info on RTX. I'm curious on your thoughts on Powell. It has had quite the run this year. POWL is the symbol. And this is a name that exploded during the pandemic. They were earning 85 cents in 2019, then $1.38 in 2020. And earnings exploded to $4.50 last year. And earnings this year is supposed to be $11.78 and up to $12.36 next year. Now, one issue is that analysts' expectations for those earnings in this year and next year continue to trend downward. And I think that's why the stock is just kind of chopping sideways to figure out where will earnings truly come in at. It's been in a trading range between about 125 and the high of 210. So that's a pretty wide trading range, probably because there's a pretty wide potential of various outcomes. Now, what do? They manufacture power substation packages, switching gear, circuit breakers, generators, motor controls, duct systems, etc. And this is kind of in the wheelhouse of the data centers, right? The picks and shovels to help with these type of facilities. They do services custom engineered equipment, systems for electrical energy distribution, control, monitoring, all the things that go into these type of systems. They also work on oil and gas refineries, offshore oil and gas production, petrochemicals, pipelines, terminals, etc. So I love the business, but I don't like the trend in earnings. And there's a lot of potential downside, just as there's a lot of potential upside. So it's kind of a mixed bag here. The technicals are okay because it's just been consolidating sideways since the move in February. It's just extremely high risk because the company has never made anywhere close to this amount of money in any given year. Not even in the ballpark. And that's the worry, is can they maintain this level of profitability? Return on equity right now is 35%. You know what the 5-year average is? 8%. And pre-COVID, return on equity vacillated between flat to 17%, right? From 0 to 17%. It's kind of where it hung out and averaged closer to the high single digits. Now we're at 35%. So is there a reversion to the mean here? That's the big question. Now they have a good balance sheet. That's a positive. Return enterprise value to EBIT is about 11. So it's relatively cheap, but it has to maintain this level of profitability. And I would really need to understand. And I've looked at this business and I can't decide if this actually can sustain it. So very high risk, very interesting name that we'll continue to monitor. But until I have confidence that those earnings aren't going to continue to trend lower, I would hold off on Powell, POWL. Thanks for the call. Let's talk a little about the Fed announcement today. And Jerome Powell said, quote, "We made a good, strong start, and I'm very pleased that we did." And he's talking about his cut of 50 basis points to 4.75 to 5% range. And what was interesting is that they saw the first dissenter on the Fed board since 2005, nearly 2 decades. Michelle Bowman voted against the decision in favor of a smaller quarter-point cut. Now, Powell said he called this move a recalibration to account for the sharp decline in inflation since last year. And that's certainly true, right? We were, 9%? Now we're at about 2.5% to 3%, depending on what gauge you're looking at. And policymakers projected the benchmark rate will continue to fall another 0.5 percentage point by year end, and then a full percentage point next year, and then 0.5 percentage point in 2026. So you're talking about 200 more basis points lower by the end of 2026. So you're talking closer to high 2s, low 3s in that range. Now, they did caution that the outlook is far into the future and very uncertain. So that's kind of what their base case is. But as we know, these things will change with inflation, with unemployment, et cetera. And a lot will change between now and even the end of next year. Now, Powell did say the economy remains strong. You have an unemployment rate at 4.2%, but they do want to preempt further labor market weakness that they've seen as of late, just as they were forced to preempt inflation strength in 2022, right, and start to raise rates pretty aggressively. Now, they declined to declare victory on the inflation front, but they did say inflation is now near the Fed's 2% target. 2% goal. So I guess 2.5 to 3% is near their goal in their minds. Okay. Now the new economic projections didn't change a whole lot, but did a little bit. Okay. The CPI index is expected to fall to 2.3% by the end of the year and down to 2.1% by the end of next year. Unemployment is expected to end the year at 4.4% and remain there throughout 2025. I don't really see that, right? When was the last time inflation ended the year and started the year at the same number? It's pretty rare. It's probably going to move. Economic growth is projected to be 2.1% this year and 2% next year. So that was in line with their previous projections back in June. But you can see that they're moving. They're bobbing and weaving and trying to figure out where neutral is. And that's kind of what they spoke about. Is getting back to a more neutral stance because the risks are balanced. When the risks are balanced, you want to be neutral. You don't want to be fighting inflation or helping the labor market when both of those potential risks are roughly evenly balanced. And so typically you have a neutral rate, meaning what is the nominal rate backing out inflation? And so that's why I think they're headed towards 3% because they see that's where inflation is going to be around 2.5 to 3%, and they want to be closer to neutral. Now, the market, and this is why I think the market sold off, the market was expecting continues to expect a more aggressive Fed. And as we've seen as of late, though, that doesn't tend to be the case. They don't tend to get overly aggressive on the dovish side because inflation is still there, right? And so they've been slower to cut rates, even if they did do that 50 basis points cut today. So that was the Fed meeting. I still think that we are headed towards decent economic growth next year. A lot will depend on government spending. New administration that comes in, whether that's a Trump administration or a Harris administration. And, what will banks do? Will they continue to lend like they are, or will they pull back? Well, cutting rates will likely spark a bit more lending because more people will now qualify. And that will help liquidity and more dollars into the system.
Good morning. This is Nick from Iowa. I'm calling in about CVS. I've bought a little bit here, wanting to know what you guys think about kind of going all in or keep buying little by little as it keeps coming down. Where do you see, obviously, your major support levels? Any information on what you think about buying in on it would be appreciated. Thanks.
All right, looking at CVS Health, and this name we had owned for clients, and bounced around, and then it broke major support back on its recent earnings announcement, and we left. We obviously won that we lost on, and that happens. But we moved on, and mainly because its cash flow has fallen pretty dramatically from a high of 19 billion trailing 12 months in the third quarter of 2022 to $5.2 billion today. And they have a substantial amount of debt. And so in order to carry that debt, they are going to need to maintain a good level of profitability, of cash flow. And they're just not doing that. Return on equity has fallen down to 9% from a high of 18%. So profitability has been cut in half. And they're just not executing as well as the market had hoped. And so while it has a lot of interesting dynamics, the debt levels are just too high for us, and there's better opportunities out there. And frankly, the chart just remains relatively bearish. It moved down in the mid 50s back in April, and it's been chopping sideways ever since. That is bearish consolidation. So no, I would not go all in. Now let's talk a little bit about consumer debt. And consumers are increasingly turning to credit cards in order to finance their lifestyles. And the main reason is because there are other forms of debt that are becoming more expensive and harder to qualify for because of higher rates. So these rate cuts could certainly unlock a lot of avenues for borrowing and give consumers a release valve. And I think that's one of the reasons why the Fed cut by 50 basis points today, is because they're seeing consumer debt trends. Now, adjusted for inflation, though, it's not as high as one would think. Right? Consumer debt hit 17 trillion for the first time last year. Okay, so all-time highs. But if you adjust it for inflation, it's grown just 3% since the fourth quarter of 2019, pre-pandemic. Okay, so this is so important for people to understand, is when they're looking at nominal numbers, they may see these big headlines, right? Consumer debt at 17 trillion. They think that's the worst thing in the world. But it's all about the ability to maintain that debt, service that debt. And when incomes have gone up because of inflation, right, that debt servicing costs have actually, in general, gone down. Why a lot of people are locked into low mortgage rates at 2.75% or 3%, right? And so inflation adjusted debt levels did touch their highest level since 2009 in recent quarters, but still over $1 trillion shy of the 2008 peak. So this isn't 08, right? And most of the debt is fixed. It's not variable like it was in 08. Now, as of the second quarter, credit card balances had grown 11% from a year earlier versus just 4% increase in the total household debt levels. And that's because other kinds of debt are harder to come by. Like I said, personal loans are number one. Banks' average 2-year personal loan rate as of May were just under 12%. And that is much lower than the 22% average on credit cards. And so what a lot of people do is they consolidate the credit card debt into these personal loans. Now, a lot of these personal loan lenders, they borrow short and they lend long, like most banks. And so when their borrowing costs on the short end of the curve goes down, they're able to offer lower rates. And that means more people are able to qualify. Now, total balance of unsecured personal loans in the second quarter grew just $14 billion from the year prior, far slower than the $46 billion year-over-year surge in the second quarter of 2022 when rates were rock bottom, right before rates started going up, right? And so this rate cut will certainly help. Even buy now, pay later firm, they in their latest analyst guidance said that lower rates will help spur a volume of growth for more users. And then there's home equity lines of credit. Balances on home equity lines of credit have risen 20% since the end of 2021. Why? Because people have a lot of equity in their homes. Mortgage holders had a record $11.5 trillion in tappable equity as of June of this year. That's a lot. And the average HELOC rate is about 9%, less than half the average of credit cards, right? And that's a lot easier to take out typically than refinancing a home, because most of those people, right, they're locked in at 3%. They don't want to refinance at 6 or 7%. It's easier to do a small HELOC. Yeah, you're paying 9 on that small amount, but the rest is still locked at that 3%. So these rate cuts are likely to really help consumers, really help lenders. And so that's why I think this is the start of the next positive credit cycle. If you look at total credit outstanding, it is growing once again, actually being down year over year last year. So it's an important factor to understand to know where the economy is going. Are banks lending? And this will certainly help. Now, I'm Justin Klein. This concludes another InvestTalk program. We thank you for listening. And we encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, Google Play. And be sure to rate and review on iTunes as well. And I hope you heard about the upcoming InvestTalk Wealth webinar coming up on October 8th at 11 a.m. And we'll focus on enhancing your retirement savings and effective strategies for managing your 401k. Independent thinking, shared success. This is InvestTalk. Good night.